All right, so in today's video, I want to talk about my 2-minute trading strategy. In this video, you are going to learn how to master sniper entries, but also how to substantially minimize your risk at the same time maximizing your reward. So real quick, as always, if you guys do find value in today's video, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. On this channel, I have over 1,500 plus free videos teaching you on how to trade, and also I live trade periodically throughout the week. So if you haven't, make sure to subscribe, but let's go ahead and let's hop into the video. All right, so like I said, we are going to discuss how to perfect sniper entries. Now, when it comes to sniper entries, we are not basing trades on the 2-minute time frame. I want to make that very clear. I do not care about any 2-minute setup on the chart. What I do care about though is higher time frame key levels. Now, when price approaches these key levels, that's when we can break it down to a 2-minute time frame, and that's where we can look for an entry. I don't care about 2-minute bull flags, 2-minute moving averages, 2-minute fair value gaps, so on and so forth. Again, higher time frame key levels, and then we wait for price to trade to it, break it down to a 2-minute time frame, and then we look for an entry. So now, where are these higher time frame key levels stemming from? There's actually a few ways that I go about finding my key levels, and I will be leaving more videos down in the description breaking down my entire trading strategy. But some of the key levels that I like to mark are previous day's highs, previous day's lows, pre-market lows, as well as pre-market highs. But then the main way that I'm finding key levels is through the use of supply and demand, as well as Fibonacci retracements. So when it comes to supply and demand, starting off with demand, the first thing that we want to look for is a large and aggressive move to the upside. So this is going to be our green candle. We'll give it a little lower wick right here, and we'll give it an upper wick right here. We want a big and aggressive move up. Once we identify that big and aggressive move up, we then want to look one candle to the left. Now, this one candle to the left, it has to be a smaller red candle. Now, as far as smaller red, it's pretty subjective to how big the green candle is. So in this scenario, this is going to be our small red candle. And what we want to do is we want to take a rectangle, identify that small red candle, and we want to draw this rectangle from the lower red wick to the top of that red wick, if there is a wick. Now, what we are looking for from here is for price to trade back down into this rectangle, and we want to break price down to a 2-minute time frame, and then we want to look for a reaction. In this case, we would be looking for a bullish reaction, as well as looking at the order flow to confirm everything is bullish. And if we get that, we can snipe our entry with very minimal risk, but the potential for a very high reward. Now, typically when price does trade down into demand, typically I don't watch the entire rectangle. I will watch the open of the body on that red candle and then the upper wick of that red candle. I'd honestly argue that about like 95% of the time, this is where price is reacting, either that upper wick or the open of that red candle. And again, when we approach those levels, simply break price down to a 2-minute time frame and look for confirmation. Now, before I show you guys some demand examples on the chart, on the flip side, we also have supply. So for supply, what we are going to look for, supply is an area that we are looking for price to reject. We want to first look for a very large and aggressive move to the downside. Now, once we get that large and aggressive move to the downside, we then want to look one candle to the left. The one candle to the left has to be a smaller green candle. So again, as far as smaller, it's pretty subjective to how big the red candle is. And again, I'll show you guys some examples here in a little bit. But let's say we have this lower wick right here, and then the upper wick right here. What we are going to do is take our rectangle. We are going to find the upper wick of that green candle, and then we're going to draw this to the lower wick of that green candle and bring it to the right. Now, what we are looking for is we are waiting for price to trade up into this supply zone. And once it trades up into it, we are then going to break price down to a 2-minute time frame, and we are going to look for a reaction on the 2-minute. Now, because this is going to be our reject zone right here, we are looking for bearish price action. So again, looking for bearish volume, as well as long upper wicks, as well as bearish order flow. And again, instead of watching the entire zone, typically I am watching the lower wick of that green candle, and then I am watching the open of that green candle. Again, 95, 97% of the time, we are having a reaction at one of these two levels. So let's go ahead, let's draw some of these on the chart. That way you guys know what to look for. So on the 1 hour time frame today on the ES futures, we do have a supply zone up here. we can see as soon as the market opened, we had a very large and aggressive push down. Look, one candle to the left, we have a small green candle. Therefore, this is going to be our supply zone. We are going to mark the lower wick to the upper wick, and then we're going to project this to the right. Now, if price were to trade back up into this level, again, I'm breaking price down to a 2-minute time frame, and I'm looking for a reaction to tell me to go short. So here's a supply zone here. I wouldn't count this as a supply because this lower wick goes down way too low. Yes, we have a nice push to the downside, but again, that lower wick literally takes up the entire body. So that would not be considered a supply zone. Same thing over here. This wick goes down way too low. Yes, we sold off substantially, but this lower wick is way too low into the body. This, though, I would consider this a supply zone. Look at the large and aggressive move down. We have a small green candle right here. So again, we are going to take our lower wick to our upper wick, and then we're going to project this to the right. I would not consider this a demand zone. Yes, we had a very large and aggressive move up, but look at how long this upper wick is. Now, if this upper wick was like all the way down here, then yes, I would consider it. But because this upper wick is too high, that would not be considered demand. This, though, I would consider this a 1-hour demand zone. Very large and aggressive move up. The wick is decently low down here. This is a smaller red candle. So what we are going to do is mark the upper wick to the lower wick of that red candle, and this is going to be our demand zone. Same thing here. This would be a supply zone, very large and aggressive move down. It's one small green candle to the left. We want to mark the lower portion of that green candle as well as the upper portion of that green candle. Price trades up into this level. It rejects it. That's where you're looking to go short. And then finally, looking over here, it's the same thing. Very large and aggressive move down, small green candle to the left. Take our rectangle, plot the bottom portion of that green candle to the upper wick all the way up here, and project it to the right. Again, I'm not watching the entire zone because as we can see, some of these zones get very large. This one is from 67.47 all the way up to 67.66, so about like a 20-point range. This one is from 84 all the way up to 06, so about 22 points. The last thing we want to do is sit here and try to guess where is price going to reject in this 22 point range. Again, that's why having those reference points of the bottom of that green candle as well as the wick of that green candle, if it has it, gives you a better idea on where to actually look for price to react. Okay, so now that you have a key level, the next thing that we want to wait for is for price to trade into it. When price is able to trade into it, you then want to look at the 2-minute time frame. Again, you can find key levels so many different ways. Personally, for me, it's Fibonacci retracement, supply and demand, previous day's highs, previous day's lows, as well as pre-market highs and lows. But that's really the extent on how I find my key levels. Now, when price trades to these key levels, you then want to break price down to a 2-minute time frame. Again, we are not taking a 2-minute time frame setup. We are simply watching the 2-minute time frame at a higher time frame key level. So for example, say that we had a demand zone down here. Price comes down to it. We then break price down to a 2-minute time frame. What we are looking for is long lower wicks or bullish price action. Even over here would have been a good example as well. Say there was a demand zone, but we come down into this 2-minute demand zone. We get this very long lower wick, but then we see the elevation in this volume. Now, is this the highest volume of the day? No. But where volume price analysis comes into play is look at the previous 2-minute candle as well as their volume. So we obviously got a volume spike right here, again going into our key level. That's all we need to confirm the trade. Obviously, the higher the volume, the better, because it's going to show you that buyers are present. But if we go down into a demand, we see a volume spike and a long lower wick or any other bullish price action, that is your confirmation to go long. So if this was a real scenario at that 2-minute candle close, that's when you would have went long. Your stop loss is always on the opposite side of the confirmation candle, and you could have potentially caught this entire move up. But now on the flip side, as we can see when we got that move up, notice this 2-minute candle right here. Maybe we went into some reject level. I don't know what that reject level was, but there could have been a number of reasons why we rejected off of that area. But look at this 2-minute candle right here. We have a very large and exhaustive move up. Lots of volume right here, the highest volume sets to open. But on that very next candle, it's a lot of volume as well. It's a smaller green candle and we have this long upper wick. So what is that telling us? Sellers are likely present at this level. Now again, I don't know what this key level was, but let's pretend that there was a supply zone up here and price rejected it with a candle looking just like this. So again, we have a lot of volume. We have this long upper wick at our key level. It's very clear that sellers are present. So again, at the close of that candle, that is when you would be looking to go short. Stop is above the confirmation candle. And one thing to make note of, if you are taking notes, I do not give my stop loss on the complete opposite side of the supply or demand zone, because again, sometimes those zones are very large. For my trading, the candle that confirms my entry, my stop loss is always on the opposite side of that confirmation candle. So at the close of this 2 minute, you'd be looking to go short, stop loss above that high, ideally looking for at least a 1-to-1 risk to reward. Once you get that, look to trim your position and put your stop loss at break even to capture a larger move. Now, when it comes to confirmation candles, because I get asked this all the time, but Brandon, that candle was green and that candle was red, why would you take it? To me, the color of the candle does not matter at our key levels. What matters to me is the wick and the volume, because at one point this was a solid green candle. But at the end of that candle, the sellers came in, drove price all the way down, and it was very clear that a lot of them were selling. Same thing over here. At one point, this was a solid red candle. But by the end of that candle, buyers came in and pushed price back up. We had a decent volume spike, so we can assume that a majority of this volume was from the buyers. So again, what you want to do is you want to mark these key levels on the higher time frames. When it comes to supply and demand, again, I will be leaving a whole video down in the description, so make sure you guys watch it, but I will plot supply and demand levels on the 30-minute time frame, the 45-minute time frame, 1 hour, 2 hour, 3 hour, 4 hour, daily, and weekly. To me, that is how I find my higher time frame levels. That when price approaches my supply or demand zones, previous day's highs, previous day's lows, pre-market high, pre-market low, or a fib, I am then looking for price to react on the 2-minute time frame to actually take the trade. I see a lot of videos breaking down how to scalp on the 2-minute time frame. Don't take setups based on the 2-minute time frame. I'm telling you, you are going to lose a majority of the time. Instead, find the setups on the higher time frame. When price approaches those key levels from the higher time frames, you then break price down to a 2-minute time frame at those levels, and you look for bullish or bearish confirmation to either go long or short. And then from there, your stop loss is always on the opposite side of that confirmation candle. But that is going to wrap up this video. So if you guys did find value, make sure to smash that like button, as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. Everybody have an amazing rest of your day, and I'll see you guys in the next video.